Good day, everyone. Today, our Group B1 would like to present the determinants of capital structure of Malaysia's construction and materials public listed companies. I'm Louis Xiaoyin, entry number 269599, and I'll begin by introducing the presentation. According to the Cambridge Dictionary website, a public listed firm is one whose shares are traded on a stock exchange. A corporation's capital structures refers to how it uses various sources to finance its overall operations and growth. It is the specific combination of debt and equity. Debt refers to money borrowed in the form of bonds or loans, whereas equity can take the form of common stock, preferred stock, or retained earnings. This study sample is made up of 11-year data from 84 companies in the construction and materials sector, spanning the years 2010 to 2020. The construction sector is concerned with the production and sales of structures for the purpose of constructing, maintaining, and repairing them, whereas the materials sector is concerned with the discovery, processing, and sales of materials to other sectors of the economy. The material sectors includes chemical, building materials, paper, steel, and other materials. The construction and materials industries are vital to a country's overall economy. It is due to their involvement in the construction of important infrastructure such as roads, building, and transportation system. Furthermore, the sector is involved not only in new infrastructure construction, but also in the maintenance and modification of existing structures and infrastructures. According to the Department of Statistics Malaysia DOSM, labor productivity per employee fell by 16% in the second quarter of 2020, putting pressure on the construction sector. It's because of the Movement Control Order (MCO), which was issued to combat the COVID-19 epidemic. Construction sites are unable to operate, resulting in project delays. The material-related business has also been impacted as materials are stranded at warehouse as a result of all projects being postponed. All in all, several independent variables will be identified and analyzed to understand how and why firms in the construction and material sector adjust their leverage based on their financial strengths, especially in the post-COVID-19 era. That's all for my part. I will pass to the next presenter.
Good day, doctor and my fellow friends. My name is Fu Yongli. My number is 277126 and I'm going to present the literature review. Although there are many determinants of capital structure, we will focus on 7 of them according to the questions. For the first one, profitability. According to pecking order theory, the higher the profitability, the higher the ability to retain earnings, and this results in a lower debt ratio because the retained earnings are sufficient enough to finance the projects. However, trade-off theory says that when a company has a high profitability, the company has the ability to pay interest payments and principal on time, so it will use more debts as there is a lower tendency for it to go bankrupt. For the second one, firm size. In pecking order theory, some says that the big companies usually have a large retained earnings and the need for debt financing is not necessary. However, others say that a bigger company size lowers the problems of asymmetry information and this gives the advantages to the company to gain debt financing on more favorable terms. According to trade-off theory, it says that big companies that have a lower probability of bankruptcy can obtain more debts from financial institutions compared to small and medium companies. For the third one, tangibility, the pecking order theories illustrate that the tangibility has a positive relationship with long-term debt financing and an inverse relationship with short-term debt financing. However, according to trade-off theory, the fixed assets are collateral acting as a protection to defend the creditor's interest, and this can lower the bankruptcy and urgency cost of the firm. For the next one, growth opportunities. Based on pecking order theory, when the retained earnings are not enough, the high growth companies will choose debt financing rather than equity financing when they want to finance their expansion. On the contrary, according to trade-off theory, the companies with higher growth opportunities tend to bear higher financial distress costs, so they will prefer to use equity financing. For the next one, interest tax shield. According to pecking order theory, there is a positive association between interest tax shield and debt rate. According to the trade-off theory, when the interest tax shield is large, the company's financial difficulties and bankruptcy costs are also significant because it's taking on a lot of debt. And for the next one, non-debt tax shields. Both theories illustrate that the non-debt tax shields is having a negative relationship with the leverage ratio because the companies tend to gain advantages from a high tax shield by using more debt financing. For the last one, GDP per capita, according to the pecking order theory, it assumes that the companies have more retained earnings and will have less reliance on external sources such as debt financing when the economy is good. However, some studies say that the companies can gain more debt financing easily as the companies can bear more financial risk when the economy is optimistic according to trade-off theory.
Good day to everyone. My name is Suepan and now I will talk about hypothesis development. We develop the hypothesis by looking into all the variables. For profitability, the hypothesis that we develop is profitability has a positive relationship with trade-off theory and profitability has a negative relationship with pecking order theory. For firm size has a positive relationship with trade-off theory and firm size has a positive or negative relationship with pecking order theory. For tangibility have a positive relationship with trade-off theory and tangibility have a positive or negative relationship with pecking order theory. For growth opportunity, it has a negative relationship with trade-off theory and it also have a positive relationship with pecking order theory. Moving on, for interest sections have a negative relationship with trade-off theory and interest section have a negative relationship with pecking order theory. For non-debt section have a negative relationship with trade-off theory and it has a negative relationship with pecking order theory too. For GDP growth, GDP per capita has a positive relationship with trade-off theory and have a negative relationship with pecking order theory. So this table is a summary of the hypothesis that I mentioned before. For profitability, non-debt taxation, GDP growth, it showed a negative relationship to pecking order. But for growth opportunity and interest taxation, it showed a positive relationship to pecking orders. For firm size and tangibility, it showed positive or negative relationship to pecking orders. For trading off, profitability, firm size, tangibility, and GDP growth show a positive relationship to trade-off, and for growth opportunity, interest taxation, and lastly, non-debt taxation, it show a negative relationship to trade-off. Next, I will talk about research methodology. Our group have gathered the 84 public listed companies in construction and materials sectors from the Refinitiv Econ data stream. The data is collected for the period 2010 to 2020 and is used to calculate the financial ratio. For the analysis method, we also conduct descriptive analysis on all the variables in terms of population and business cycle. We also use the ordinary linear regression method (OLS) to regress the independent variable against the dependent variable, and all the data are performed by using SPSS.
Good day, Doctor. I'm UG277909. I'm now going to talk about the results from the descriptive analysis based on the populations and based on the business cycle. So, in short, we can observe that the Malaysian firms in the constructions and material sectors have high leverage, which amounted to 1.302 of mean value for total leverage. So, this indicates that the firms in the constructions and material sectors are a high-risk sector, as the firms owe the debtors for every RM 1.302 with every RM1 of shareholders' equity. So in addition, the interest taxation of the firms in the constructions and materials sectors is considered moderate while the profitability of the firms is very low. So this indicates that the firm does not have enough profitability to cover its operations. In addition, the interest taxation of the firms in the constructions and materials sectors is considered moderate, albeit the profitability of the firms is very low. So this indicates that the firms does not have enough profitability to cover its operations and opt for debt financings. So as a result, interest taxes are very high compared with profitability. Therefore, trade-off theory applies in these situations and hypothesis 1 is accepted. Moving on, we have the next slides. So for independent variables, the sensitivities towards the business cycles are explained by trade-off theory and pecking order theory. So what we can see in the slide is that based on the analysis of firms in the constructions and materials sector in Malaysia, all leverage variables, which are the total leverage, short-term leverage, and long-term leverage, react positively to the expansion phases in the business cycle because they all increase in the expansion period. For independent variables, profitability, tangibility, firm size, and interest taxes reacted positively towards the expansion phases, while the growth opportunities, non-tax texture, and GDP growth react negatively to the expansion phases. So I will now pass the presentation to Vincent Tan to So I will now have Vincent Tan to talk to you about the regression analysis that further dig into the relationship of the independent variable and dependent variable with the results based on the regression analysis. Please, Vincent.
So my name is Vincent Tanyangi and my metric number is 278827. I would like to talk about overall population on construction and materials sector. So based on table 5 and table 6, the profitability variable has an inverse relationship on all models. Besides, the firm size variable has an positive effect on model 1 and model 2. In contrast, model 3 has an inverse relationship on the firm size variable. Also, the tangibility variable has an inverse relationship on all models. For the growth variable has a positive relationship on all the models. So next, the tax interest tax variable has a positive relationship with model 2. In contrast, model 1 and model 3 have an inverse relationship with interest tax shield variable. So NDTS show an inverse relationship between all leverage. And at last, the GDP have an inverse relationship on all models as their beta values are all negative values. So next I will say about the trade-off theory and the pecking order theory. So the trade-off theory shows a positive impact between profitability and debt ratio, while the pecking order shows negative between two variables. The pecking order theory will form a negative association between debt ratio and profitability. So hypothesis 2 is accepted and rejected the hypothesis 1. Firm size and debt ratio should have a positive relationship between each other according to trade-off theory. On the other hand, the pecking order theory predicts an inverse relationship. In short, hypothesis 3 is accepted for long-term leverage and total leverage, while hypothesis 4 is accepted for short-term leverage. And the trade-off theory implies that tangibility should be positively connected to debt ratio. Pecking order theory indicates that tangibility should have a negative association towards short debt financing and positive association towards long-term debt financing. As such, the result allows us to accept the hypothesis 6, whereby the result can be explained under pecking order theory for all for the leverage. So according for the pecking order hypothesis, growth opportunity tend to have a positive correlation with the company debt ratio. But according to the trade-off theory, growth opportunity should indeed to negatively connected to the company financial leverage. Thus, the result attests the hypothesis 8. And next, according to the trade-off theory, negative relationship is found between the interest tax shield and debt ratio. So unlike trade-off theory, pecking order theory justifies that when tax benefit from debt is high, the cost of debt will decrease. So this result allows us to accept the hypothesis 9 and 10. And last, according to trade-off theory and pecking order theory, NDTS indicate that this variable is negatively related to leverage ratio. Therefore, the result affirmed with the hypothesis 11 and 12. And GDP growth has a negative relationship on all leverage, and this allows us to accept the hypothesis 13.
Good day, doctor. My name is Jordan Chanjun and my matrix number is 279721. I am going to talk about the results of multiple regression for business cycle. This table shows the result of multiple regression for TLT, LDTE, SDTE towards profitability, firm size, tangibility, growth opportunity, interest tax shield, non-debt tax shield, and GDP growth. The results of relationships obtained from regressions analysis are being compiled and categorized. This slide, we talk about the real effect result. Based on the result obtained from profitability variable, we can conclude that the business cycle has caused disturbance in the determinants of capital structure from the perspective of the Malaysia firms in the construction and material sector, as the firms prefer short-term debt financing and prove the trade-off theory in recession stage 1. Besides, the results indicate that the firm prefers internal financing in expansion stage and recession stage 2 and prove the pecking order theory. The results for firm size variable show that in the recession stage, the firms behave under pecking order theory, in which they prefer internal financing rather than debt financing. In expansion stages, the firms have mixed behavior in capital structure, whereby they prefer debt financing and internal debt financing. Due to this behavior, pecking order theory prevails as the theory says that the firm does not have specific preference in method of financing. The results for tangibility variable show that the Malaysian public firms in the construction and material sector followed pecking order theory in their capital structure decision. The results for growth opportunity variable shows Malaysian public firms in the construction and material sector followed trade-off theory in their capital structure decisions to adjust to the expansion stages and the recession stage 2. The results for interest tax shield variable shows the Malaysian public firms in the construction and material sector followed trade-off theory in their capital structure decisions in recession stage 1 and expansion stages, then followed trade-off theory in their capital structure decisions in expansion stage and recession stage 2. The results for non-debt tax shield variable indicates that the Malaysia public listed firms in the construction and material sector prefer debt financing to get the tax benefits of interest tax shield under trade-off theory. And for GDP growth variable, we can just conclude that it is one of the concerns for the firms in construction and material sectors to adjust their leverage. In short, under the business cycle, the firms showed interesting behavior in adjusting their capital structure when compared to the population model. The results suggest that both pecking order theory and trade-off theory can be used in explaining the capital structure decisions by the Malaysian firms in the construction and material sector. So we move to the conclusion. The drivers of capital structure for Malaysian publicly traded companies in the construction and material industry, according to the findings, are not mutually exclusive and cannot be described by pecking order theory or trade-off theory. Furthermore, the economics cycle has an impact on the drivers of capital structure for stated enterprises, as evidenced by the population regression study, where the firms made considerable capital structure modification. As a result, the business cycle can be used to more precisely pinpoint the determinants of a company's capital structure, because the data reveal that profitability is inversely proportional to overall leverage. The pecking order theory is employed. Overall leverage is positively influenced by business size, which can be explained by using trade-off theory. When tangibility has a detrimental impact on overall leverage, the pecking order theory was validated. According to this justifiable trade-off argument, total leverage has a positive relationship with growth. The fact that interest tax shield has a positive relationship with average leverage supports the trade-off theory. Non-debt tax field found a negative relationship between overall leverage and non-debt tax shield, proving the trade-off argument. The fact that GDP growth has a negative relationship with total leverage supports the pecking order argument. All in all, business cycle analysis on determinants of capital structure proved to be more precise when compared with the general population model, which is based on descriptive analysis and regression analysis. As business cycle clearly labeled the expansion of the economy and the recession of economy that clearly reflect the reality of financial world. However, the business cycle is hard to determine correctly, and this proved to be the limitation of this type of analysis. The author hopes that this is the study can be used by the relevant authority and government bodies to be served as a reference to map out good financial policies that can enhance public listed firms in construction and material sector. Thank you.